Hello and welcome to Thank God It's Friday. I'm in conversation with Arnab Das, and he's the head of macro research, global emerging markets at Invesco. Arnab, thank you for joining us today.
Pleasure. Thank you for having me.
Well, Arnab, I'm going to start off with the question that everyone has on their minds. We do know a little more now about the Trump administration and what they are thinking. The US has left the Trans-Pacific Partnership, and they're looking to impose about 20% tax on imports from countries like Mexico. A lot of folks here are wondering what this means for the US economy and the dollar especially, which has gained substantial strength over the past couple of months.
Yes, I think these are the kind of the burning issues of the moment. As you say, I think we know a bit more, but we don't know the entire story. And I think we still have to parse out quite a lot between the tweets, the policy pronouncements, the signals from the inner circle within the administration, and from the cabinet ministers, many of whom have now been approved, although not all. I think what we can say is that there is a shift from a multilateral open trading regime to a much more pick and choose kind of situation, which will probably be oriented towards bilateralism rather than multilateralism in trade deals, and some degree of renegotiation with the threat, with the stick of tariffs as a kind of threat to the country or the sector in question for renegotiating the trade arrangement, and also as a to show that President Trump, not just in the first 100 days, but indeed in the first 10 days of his administration, has moved on those issues that are under the purview of the executive branch without requiring congressional approval, right? And those issues are trade and immigration, by and large. So on the specific issue of this idea of a 20% tariff, so you'll remember that during the campaign, the idea had been 45% tariff on China, 35% on Mexico, and so that's now been substantially rowed back. It was rowed back to 30, then to 20, and indeed, in the immediate aftermath of some of these tweets and press conferences, the 20 has also been rowed back further to something between 5 and 20. So, I think where we're headed is like I said, is a much less multilateral, much more interventionist sort of regime now than what we had before, right? Much more bilateral and much more targeted at individual countries and sectors. I don't think we're looking at isolationism or generalized protectionism, right? And I think that has important economic and financial market consequences. The main one is that instead of having a general overarching impact across the board, the eventual economic impact is much more likely to be idiosyncratic, right? Country-specific, sector-specific, maybe in some respects even firm-specific. So a very different kind of approach than we have been used to from the United States in anyone's living memory, right? I think that is also important in a kind of systematic sense, in that there's a domestic agenda, not just about making America great again, putting America first, and not just indeed about creating jobs in the U.S., but generating higher growth in the U.S., maybe generating some reflation, and in particular generating an increase in investment through deregulation, right? So that would imply, at this stage of the cycle, which is arguably mid to late U.S. cycle after 7 or 8 years of recovery, probably some inflation pressure, a more hawkish Fed than otherwise, and a stronger dollar. But of course, all of those things would run against the idea of engineering an investment boom and engineering maybe something of a reversion in the trade situation in the U.S., where the U.S. is the biggest importer, to something of a more aggressive exporter to the rest of the world. So I think that's why we're seeing a lot of inconsistency here and seeing this tweeting, this kind of verbal intervention against the dollar strength that you mentioned.
Considering you've spoken about some of the economic variables here, I want your comment on the state of the U.S. economy. Now, Janet Yellen has indicated that there could be at least 2 more rate hikes this year, at least. But many believe that she has very little leeway to do so. What is your opinion on this matter?
Well, I mean, I think she has the leeway that she needs to raise interest rates if, in fact, inflation continues to rise, and in particular the labor market continues to tighten. Right, the Federal Reserve Act grants the Fed a mandate, imposes a mandate. We all think of this as a dual mandate: full employment and price stability. But actually, there's also a third leg to the mandate, which is moderate long-term interest rates. And by now, the Fed is more or less firing on all three of those cylinders, right? So if the labor market continues to tighten, it's pretty clear the U.S. is at or near full employment. There's a bit of uncertainty because of the labor force participation rate. But the general story is that the labor market is tightening. Wages are starting to go up. Inflation measures are rising. So I think it's reasonable to expect the Fed to tighten a couple of times, and maybe even potentially more than twice, depending on what happens on fiscal policy, depending on what happens on regulatory policy. If in fact there is a big deregulation over the course of 2017, and a big or meaningful at least fiscal stimulus in 2017 going into 2018. That will affect the outlook, obviously, this year and next year and the year after, and so the Fed will have to factor that in. Now, I'm not trying to say that means there's going to be a huge amount of hiking. It remains to be seen, and indeed what Chair Yellen has said is largely in line with what the market is already pricing in, and that's why I think you haven't really seen a big strengthening of the dollar in the last couple of weeks, right? This had been substantially sort of priced in already.
Right. I address protectionism here, and a lot of industries, at least in India, are certainly very, very concerned out of all the news that's been coming out of the US, specifically the information technology industry and the pharmaceutical industry. What have you made of this, all the news that's come out, and do you think that it could have a really, really severe adverse impact going forward?
Yeah, I think Indian industry, Indian exporters are right to be concerned. They're not the only ones that are concerned. Pretty much everyone is concerned, pretty much no matter where they're located, right? Whether they're located in a country like India with services surplus or surpluses in some sectors, and maybe an overall trade deficit, or large surplus countries with the U.S. like China or Japan, Germany, or indeed Mexico, right? Several of those very large surplus countries have clearly been in the firing line of at least the Trump tweets, if not yet a major policy change. I think India as a whole is relatively insulated because it is for one thing, it's a large closed economy. For another, it is not running large overall trade surpluses or even large bilateral surpluses with the United States. But that, of course, is a kind of macro perspective, and as we were discussing before, a lot of this interventionism is targeted not just at the overall trade balance, but at particular sectors and maybe even particular firms. So I think there are reasons to be concerned. I think there's also a kind of underlying reason to be concerned because there's a great deal of internal inconsistency in this agenda, right? If you think the president would like to see lower prices for pharmaceuticals, or at least so he said, for the U.S. healthcare industry and for U.S. consumers. And of course, one way to achieve that is to have more generic or lower cost producers, which are located primarily outside the United States. And of course, the United States is a proving ground for a lot of innovative, new medical technologies, and a lot of the testing occurs there, making that a very good place to do business in a certain sense, but also a very high cost location. This idea of deregulating industry in general, sort of is inconsistent. Deregulating industry onshore and putting up barriers against industries and firms offshore, that's inconsistent with internally and with lowering the price overall. So it remains to be seen how all of this plays out. But I think we're going to have to get used to this kind of inconsistency because in contrast to the past, there isn't an overarching macroeconomic design in U.S. economic policy at the moment, in which things are done from the top down, and what happens in the bottom up in different sectors and different firms has to be reconciled with this overarching vision. It's the other way around. It's topsy-turvy, right? We're starting from the bottom up, deregulating this sector or that sector, imposing trade barriers, this country, that country, potentially imposing trade barriers, or that sector. And so what we'll have to, how we'll have to reconcile that and square that circle, instead of the top down leading and the bottom up following, it's going to be the other way around. So I think that's complicated for individual sectors and firms in different countries. And I think the main sort of market implication, the main sort of economic implication, is a great deal more idiosyncrasy. So if I were in the Indian pharmaceutical sector, I would be looking very carefully and maybe trying to have a very close dialogue with the appropriate people in the FDA, the appropriate people in the administration, maybe some lobby groups, that sort of thing. Right?
Well, okay, so I'm going to come down to energy, and once again, the Trump administration has given certain signals of lifting restrictions on coastal oil drilling. There are also considerations of lifting restrictions on coal mining. Where does this take oil and oil prices, especially if mining comes in full flow, and will then coal also restrict an upside to crude prices?
Yeah, so I think this is a particular aspect of the deregulation agenda, and also the agenda of restoring investment and job opportunities in certain politically critical states, including Pennsylvania and other states that have suffered from the exodus of investment from coal mining. I think the bottom line here is that the general trend away from coal and even away from oil has a certain amount of momentum. Some of that momentum is being reversed, has been reversed by the collapse of the price of energy and other commodities in the wake of the strong dollar and the slowdown in the global economy. That is now reversing course because the global economy appears to be firing more solidly on all cylinders. So I don't think the short-term question is really about a price effect, right? It's really a long-term question about how much investment this is going to generate and how much of a shift in the supply-demand balance there will be. Probably we don't think it's probably going to be that extreme, right? Because OPEC and even Russia and other non-OPEC producers are back in the market, balancing supply and demand in the oil market, and that's sort of helpful even to the shale sector in the U.S., which has had to adjust significantly, but appears to be chugging along even at $50 a barrel and change oil. So we don't expect a huge move in the price of oil really here one way or the other. What's more likely to happen is that there's going to be more investment, more competition, and maybe the balance of power in the oil market and the energy market generally continues to swing away over time from OPEC and from major producers of coal to a much more sort of market-determined price in a more deregulated environment in general. So as long as the world economy continues to hold up, which, pending this issue of protectionism and immigration restrictions and so on, we think, things are still, reasonably okay. We don't expect a big move, like I say, a big move in the price of energy one way or the other. It's not a perfect environment, but it's a better environment than we've been in for several years, because the U.S. is, growing reasonably okay. Maybe it'll accelerate with the Trump agenda. Europe is doing pretty well. China, through monetary stimulus, appears to have stabilized its financial system and its economy, and appears to be growing, reasonably well. There's, mixed signals here and there, but generally it's growing again strongly. So the international environment, economic environment, is reasonably supportive, subject to these policy uncertainty risks.
Well, we've actually had a viewer question. This question was from Muhammad Rafiq, and he did want to have an outlook on oil. And I hope that Arnab sir addressed that question. But Arnab, I'm going to move on to emerging markets now. Actually, before I move on to emerging markets, I do have a question on Brexit. And Prime Minister May is looking to trigger Article 50 in the next couple of months. Any ideas on what the terms will be?
Well, I think it's very early days, and we're still very much in the posturing stage. You know, yesterday the UK government published its parliamentary white paper on Brexit, long awaited, and initially, sort of denied by the government because it didn't want to tip its negotiating hand. So I've read through the white paper. It's 77 pages long, which would suggest that there's a lot of detail, but there are a lot of blank pages, a lot of title pages. And still, I would say there's a lot of general statements which are fairly clear, but there's not a lot of detail. There's not a lot of specificity. So what seems to be happening in the white paper is consistent with what's been said in the parliamentary address and the Conservative Party conference back in October, which points towards, quote-unquote, a hard Brexit, because there's the idea of an exit from the single market of the European Union and also from the customs union of the European Union. Now, I think that at one level that is a hard Brexit, but within some of the specifics that are there, limited as they are, there's also the suggestion that there be something of a bespoke approach, quote unquote, an approach that is somewhat sector specific if the UK government can achieve that in negotiations with the European Union. Now, the European Union's position today, led by the European Commission, has been relatively hard Brexit. But there's been no significant commentary since the parliamentary address or the white paper yesterday. So I think we're still in these kind of early days, and I think what we can expect in the wake of the Article 50 trigger, which is likely to be in March, as you say, is probably continued posturing, some details of negotiation of the relationship between the UK and the European Union as an entity, but no real substantive progress on the underlying issues of Brexit until we get through this highly politically charged year in Europe. We have 3 very important elections scheduled this year, and probably a 4th: Netherlands, France, Germany, and Italy. All of those elections are likely to point away from more Europe, away from more European integration, and towards more national revivalism, consistent with the Brexit referendum itself in the UK and the election of President Trump in the United States. So it's hard for me to believe that with everyone sort of pointing towards more nation state and less integration, that when the negotiations begin in earnest in Q4 of this year, that the Commission is still going to dig in its heels and be very hard-nosed about this. So I think what we're going to see is a period of posturing and volatility, with sterling probably in the firing line of that volatility for the next couple of quarters. And then we're going to see some serious negotiations where there is a prospect of some compromise in late 2017 and 2018, going into the actual exit in 2019.
Well, okay, so now I'm going to come down to emerging markets, and I'm going to peg India against China in this case. Would it be fair to assume that flows in these markets specifically will be more dependent on decisions taken outside, that is in developed markets, as compared to locally driven factors? And where does India stand in comparison to China when it comes to fund flows?
Okay. Well, I think that applies, that question, whether it's a systematically driven, globally driven emerging markets environment, applies as much to India and China, and maybe more so to the rest of emerging markets than these 2 very large economies. I would say that there's been a very systematic component to the story over the last many years because of global financial flows, not least in the wake of QE in the US, Europe, and Japan. And I think that, kind of rising tide or receding tide, moving all boats up or down, that effect is going to continue to some degree. But I think we are starting to get a much more, as I was saying before, a much more idiosyncratic kind of world shaping up here. Not to say that country specifics will become the be-all and the end-all and the dominant factor in every circumstance or in every asset class. But the weight of what's going on in the country in question is likely to increase. And I think in the case of both India and China, that is going to be that has been the case more than many other markets, will continue to be the case. Why is that already the case in India and China? Well, those are the two largest EM economies. Of course, China is significantly larger than India. They're relatively closed to trade and international capital flows compared to many other smaller, more open emerging market economies, just by virtue of economic size. And they're also relatively closed because of capital controls. So there is a significant but lower systematic component, global component of the story in those two countries. It is likely to diminish further in those two countries, China and India, compared to the rest of the world. Now, there is a potential exception for the case of China because of the high degree of trade exposure between the U.S. and China compared to India and the U.S. I personally don't think there's going to be a full-blown trade war, but you know, and that is actually a shared Invesco view, house view. But there is going to be some change, it would seem, in the way these trade relationships work. And of course, in the end, trade relations and trade rules are partly about trade, but they're also substantially about investment, right? And what is happening here is I would say in the U.S. is an effort at a new kind of import substituting industrialization strategy, right? Which used to occur in many emerging market countries in the distant past. Continues to some degree at the moment in China and India, and didn't really work in the Indian case in the 1950s and 60s, right? You'll remember the infant industry argument and protection against all these highly competitive global multinationals, where small firms and small economies couldn't really compete. Well, what that did was generate large firms in large economies which couldn't really compete because they were sheltered. Now we have a much more open, competitive international trading environment where companies from the developed and emerging market countries are competing very well head-to-head with each other within DM and within EM and between EM and DM. I think the Trump administration sort of feels that's gone too far for the American worker, so they're going to roll back that to some extent. I think what's likely to happen is that if there is a significant element of that, or if it does trend in the direction of trade war, then emerging Asia is particularly exposed to that. But I think what's more likely to happen is bilateral renegotiation, which mitigates the trade flows, which are already much less of a contributor to global growth. Global growth is going to become much more dependent on domestic demand, domestic business cycles as a result. Hence the argument for more idiosyncrasy rather than sort of globally systemic, synchronized kind of business and financial cycles. And I think China will try in that regard to bring Asia together and pull it along in the wake of its own economic development. Now, the trouble for China, of course, is that it is seeking to rebalance from manufacturing towards services, and at the same time, it is seeking to onshore a lot of the supply chains that are there within Asia, and ultimately destined products for manufactured for export to the West. Reorient some of that some of that regional production towards domestic production, and aim it towards the domestic market rather than the export market, as well as shift the economy from rebalancing from manufacturing and net trade towards services. Now that's quite a mammoth agenda, right? It involves a lot of change at a time when the global economy is also changing. So it might be quite a bumpy transition, but it might not be the kind of full-blown trade war that many people are worried about. I mean, we would be worried about a trade war as well, but like I said, we don't think that's what's going to happen.
Okay, so how would you rate the union budget, which was presented a couple of days ago? In general, the feeling is that the government has stuck to being fiscally prudent. Are those your thoughts as well?
Yeah, so I mean, I think the macro policy story in India, as it's unfolded over the last several months, increases the argument for idiosyncratic behavior in India, starting with demonetization and continuing with the budget. So the budget, as you say, I mean, our assessment of the budget is very similar to what you've just said, which I think is the general consensus that it is a relatively fiscally prudent budget. It hasn't, relied on an excessive amount of benefit, fiscal or RBI kind of seniorage benefit from the demonetization shock. And so the budget generally has sent all the right signals. I would say demonetization, scared a lot of people in India and in the rest of the world. But it seems to have, although there were implementation issues and sort of teething problems, execution issues, it seems to be passing without a tremendous downside shock. And what seems to be happening is that growth is holding up reasonably well, although it's down a bit. And inflation, idiosyncratically compared to the rest of emerging markets, is down significantly, partly probably because of the monetary shock of demonetization, and also substantially because of the harvest, right? Because of the monsoon and the second harvest, and so on. So I think the story in India is still relatively attractive because, like I say, growth is holding up and inflation is still going down. So for macro investors like ourselves, that's a pretty good environment. India, we have quite a big exposure. It's off index for most of our global funds. We also have a domestic asset manager, Invesco India in Mumbai, used to be called Religare. So we're quite, I would say, optimistic, despite the challenges that India faces. We think the government is handling those challenges relatively well. And demonetization appears to ultimately have gone smoothly.
That was actually my final question. The government is projecting about a 7% GDP growth for fiscal 18, and does that mean that demonetization, that is the worst of demonetization, has come to pass, and from here on it can only get better?
Yeah, I think we may continue to see some of the pass-through of the monetary shock in some of the activity numbers and some of the inflation numbers, sort of this quarter, next quarter. So I'm not sure I would say that necessarily the entire worst of it has passed, but just that, but more sort of in a nuanced way, right? That the downside risks of demonetization have not been borne out, right? Relative to expectations and fear of what could have happened, the process is turning out to be much less of a business cycle shock, a demand shock, than many people feared, and we ourselves were quite concerned about it as well. So I think, relative to expectations, things are significantly better than they were, and I would say that the increase in liquidity in the interbank market, some of which has been mopped up by the RBI, is a factor in holding down bond yields, holding down interest rates, and so that's kind of a good thing in a certain sense. I think the key issue now is to regenerate investment, and for that, further reform is needed. The GST needs to go through to be clarified and implemented. Further structural reforms need to be implemented, and of course, the issue of NPLs in the banking system critically needs to be cleaned up, so that corporate credit supply can resume, and that involves cleaning up the NPL liabilities both in the corporates and the non-performing assets in the banks, right? So still some work to do to maintain this growth trajectory, and 7%, of course, is very good for any emerging or developed, let alone any developed economy. But to reach the kind of idea that there's some 8 to 10% Chinese-style growth rate in potential in India, a lot of these reforms need to happen. And they need to happen, as soon and as well as can be achieved in order to get there. And we need to bear in mind that the idea of make in India for export to the rest of the world was always going to be a tough sell. In today's world, now that China has already so aggressively trodden that path, after so many countries in East Asia, starting with Japan, and all the way up to Korea and so on, have already trodden that path in the last 50 years, it's probably not going to happen for India in that way, right? Make in India is going to be for mainly Indian consumption in the end. So that's all the more reason why these reforms need to go through, and all the more reason why the budget needs to be very prudent, right, to keep the external imbalances in check.
Well, actually, I do want to add just one more question, Arnab, and this is to do with the NDA government. Should they not fare well in the upcoming state elections? Would there be a cause for concern? The reason why I ask is, would that mean letting go of fiscal prudence and resorting to dole-outs, which could have an adverse impact on the economy?
Well, of course, it's always possible for there to be, more, let's say, more populism in response to electoral setbacks. But I think if the government had calculated that it needed to do a lot of fiscal pump priming in order to be better positioned for the elections, it would have done that going into the elections rather than in response to them. So, I mean, I think the general stance of policies makes sense, right? And a lot of what seems to be happening is to get the micro and the macro right in India. And that's one reason to be bullish, and why skeptics like myself have been sort of brought along. To keep that going, the government should respond to a setback, I think, by not loosening the fiscal, but more aggressively driving forward with the structural agenda, and keeping the fiscal as tight as possible. Because if it improves the structural conditions in the business operating environment in the Indian economy, cleans up the banks, cleans up the non-performing loans and assets, and makes it a much easier place to invest, then monetary policy can be looser than otherwise. The external balance will be better than otherwise because the fiscal will be tighter, and the business operating environment will encourage more investment, oriented, like I say, towards domestic demand. That whole story can hold together very nicely, rather than struggle against a world with a lot of uncertainty about trade, a lot of uncertainty about financial conditions, and potentially volatility that shows up in the rupee or interest rates, and affects expectations about inflation and about real incomes and wealth. So I think there's a very good chance, I wouldn't say regardless of the outcome of the state elections, but whatever those elections, however they pan out, there is a way for the government to continue with its agenda and to deliver reasonably good results for the Indian economy.
Arnab Das, it was a pleasure speaking with you. Thank you very much for your time.
My pleasure. Thank you.
And as for you guys, don't go anywhere. Stay tuned in to Bloomberg Print, but we will be back next week for yet another edition of Thank God It's Friday. Till then, it's goodbye.